It's great to see so many agents of impact. Many of you have been on these calls before, so you know that now is the time to introduce yourselves in the chat. Maybe say where you're coming from geographically, and maybe if you do have a worker ownership connection, either as a worker or an owner or a business owner of some sort, or in any other connection, just make sure everybody knows who's in the room, as it were. I want to bring in my colleagues Dennis and Rudy, who've both been kind of all over this ownership beat. We've been trying to get over get all over what we call the ownership economy, of which worker ownership is really only one part. Dennis, the call is, oh wait, let's actually, before we do that, say hi, Dennis, and say hi, Rudy, and then I want to bring in the guests.
Oh, hello, everyone. Nice to be here. Thank you for joining.
Yeah.
Rudy, there you are.
Hi.
So let's just introduce the guests, but then I want to just engage Dennis and Rudy for a second. Smitha Das from World Education Services. Welcome, Smitha.
Hi, David. Thanks for having us.
Terrific to have you here. Todd Leverette from Apis and Heritage Capital Partners. What? Todd, you've broken the first rule. You're on mute.
I'm going to do it at least one more time. I promise you. But thank you so much, David and team. Happy to be on the call. Happy to see everybody here.
It's great to see you. Ian Mohler from Mosaic Capital Partners, I think in Charlotte, North Carolina. And you've broken you're the second one to break the rule.
Yep, sorry about that. I guess it's an ESOP thing here, but yes, Ian Mohler with Mosaic Capital. Thanks for the invite and happy to be here.
Great. And Zoe Schlag, an old friend of ImpactAlpha's from Common Trust. Welcome, Zoe.
Hi, everyone. Good to be here. Thanks for having us.
And finally, but not least, of course, Annalisa Miller of Ownership Works. Welcome, Annalisa.
Thank you. So great to be here. Appreciate it.
It's a great lineup, as you can see. But Dennis, the call, maybe, I don't know whether the timing was fortuitous or whether it's all just in the air. There's labor and capital are sort of at the top of the agenda. There's the auto strike. I guess they just settled the Writers Guild strike. Just give us a little context of what we're up to today.
Well, great. Yeah, I mean, it's something we've been thinking a lot about as we cover the fund managers and the investment strategies on today's call, which is that at least in the media, but also in the marketplace, labor and capital are often seen at odds with each other and pitted against each other. Where the folks on this call have the opposite view, which is that if you can find the structures and the support that aligns labor with the success of the business, that actually is good for investors, as well as being good for workers and wealth gaps and then the broader impacts. So we're excited about that part of the conversation on today's call.
Terrific. And Rudy, you've been, as I said, all over this ownership beat, which is broader than just worker ownership, but home ownership, business ownership, community ownership.
Yes, I have, David, and all of the amazing folks we're going to hear from in a few and many others in this growing ownership economy ecosystem are working every day to prove that the path to inclusive wealth runs through ownership of assets, whether that's real estate, businesses. So I'm really excited to keep digging in, and everybody stay tuned.
Great. So Smitha, let's start with you if we could. In the context of this, I would love you to just explain a little bit about World Education Services and the fund, but maybe you've built a whole portfolio around what you call the ownership pyramid. So how did you arrive at that framing?
Absolutely. Well, Rudy kind of set us up pretty well for this conversation. World Education Services is a social enterprise. Our main focus is to help people work, learn, and thrive in new places. That's the core mission. And so as I was brought into the team to build out our impact and mission investing practice, the question was, how can we advance the mission, reinvest some of the surpluses of the business And the way we focused our efforts so far is in 4 investment themes. We invest to advance opportunity, wealth, power, and justice. So particularly when we dug into the wealth thematic and looked historically, how have individuals been able to build wealth? Historically, it's really through asset ownership, right? Particularly owning your own home, owning your own business. So how can we unlock access to home ownership and employee ownership for frontline workers, immigrants, BIPOC workers, the communities that WES is so focused on? And that's what led us on this journey to build a bit of a portfolio around ownership, shared ownership, if you will. And the pyramid itself actually is a kind of a brainchild of Wes and the Gary team. I see Catherine on the call. And so very much something we've been building in partnership with many other investors in the field, but it's looking at ownership across different types of assets: financial, asset ownership, home ownership, business ownership or employee ownership, tenant wealth equity models, and then finally community ownership, where we're actually doing our first deal in the real estate space at WES in that arena. And so particularly with the employee ownership, which is of course the focus of this call, we're really excited to build a portfolio around that and have even a couple of our partners speaking today.
Terrific. So I was going to ask you what's in the portfolio. I know that
Sure.
Yeah, give us a few samples.
Yeah, sure. I mean, we've looked at a lot of really great models. I think it is a bit of a learning curve to get your head around the different types of transaction structures to become an employee-owned company. There's really 3 in the market: an employee stock ownership program, the ESOP model, the worker cooperative, and finally the employee ownership trust, or EOT. And so what we've really been trying to do at WES is plant many seeds and try to demonstrate these models with a particular lens around a racial equity lens, right? Trying to support BIPOC workers, immigrant workers to advance in the journey of intergenerational wealth building. And then second is we're really particularly interested in models that are looking at the intersection of wealth and power. So while others may invest in, say, a pure play ESOP, we're particularly interested in the models like what the APIS and Heritage team are demonstrating, right? They're in our portfolio to think about how do we merge the benefits of an ESOP with the cooperative democratic governance principles. And so that's why we got excited about that deal. We also are excited to support Zoe with Common Trust as she launches this new fund in the market to really take EOTs to scale, and in a really smart strategy, she's looking to reduce the transaction costs of EOTs through the tech platform I'm sure she'll speak about today. And the other 2 organizations in our portfolio are, one is Oberon Cooperative, which is looking at cooperatives actually at the holdco level. So instead of an individual worker buying into their business and having ownership stake in their own business, it's actually at the conglomerate level. So it's a really interesting model to try to take co-ops to scale. And then the last portfolio company for us is Project Equity, and Allison's on the call. She's a true expert in this, but they're doing not only investments in transactions across the 3 types: ESOPs, EOTs, and cooperatives, but they're also really building a big platform to build the field. So I'm sure she can share more in the chat and during this call.
Smitha, you get the role of you're an LP in these funds, and so I just want a little bit of the sort of LP investor perspective of how do you think about the return expectations and the sort of risk factors in these kind of investments?
Sure. So there's a couple different factors here and very different types of investments we've made. Some are looking at more market rate type investments. I would argue kind of the Common Trust APIS models are really trying to demonstrate that you can do this and do well and take it to scale with more commercial investors in, say, a fund 2. So we're really excited to demonstrate that side of the market. There's also the Project Equity type investments that we've made, which is really looking at this more of an impact first approach and how we can build the field. And so that's where we're looking at a slightly different risk return profile that's more patient and catalytic. And so I would say that you can make investments across the spectrum of capital in the ownership space. It's really more of a thematic in your portfolio. And particularly as we look beyond employee ownership, it can be across asset classes as well, including in real estate and in other markets. So happy to say more.
Well, I did just stick on that because I thought that was interesting when we were chatting the other day, that if you take into account other ownership models, that you actually also get diversification of risk and returns, as you said, through real estate and even CDFIs and other kinds of investments that help with the diversification. Do you want to say anything more about how you've seen that?
Yeah, no, I think it's a really interesting way to round out a portfolio, like you said. I mean, how can we think about ownership as a theme across your portfolio? And even in some models that are maybe more traditional, is there an ownership angle in the way that you think about an exit play to an investment that you may make that's a direct equity investment? Is there an ownership angle as you think? So I think I've actually, because we invest across structures, we do direct equity, debt, we do all types of investments at Wes. And so I'm actually finding that some of the learnings I'm taking in from these pure play employee ownership deals, I'm bringing those into the conversations, even in more traditional venture conversations. Like, what is the growth trajectory here, and what is the exit scenario? Is it always private equity? Are there other buyers out there for businesses?
Well, that's actually a good segue to Todd. I love the notion of an ownership lens, Smitha. So thank you, and stick around. But
I will offer credit to the Social Capital Partners team for that one.
For an ownership lens, okay. So, Todd, Rudy, I think you've spoken a lot with Todd. So why don't you take it away with Todd?
Yeah. Hey Todd, so you raised your first fund with $58 million, and you've made your first 2 deals. I'd love for you to tell us more about Apis and Heritage and what you guys are doing.
Todd,
you're muted.
Thank you so much. Thanks for the question. Yes, indeed. Really excited to be at the point where investors such as Smitha and the West team have enabled us to kind of hit the goal of our fundraiser, really exceed the goal of our fundraise. And so, Rudy, tell me, I was trying to unmute. You want me to tell you a little bit more about the companies that we've invested in, correct?
Yes, tell us a little bit about Apis and Heritage and your portfolio and what you're doing.
Okay, wonderful. Apis and Heritage, we are a lower middle market mezzanine debt / structured equity fund. For short, we're an employee ownership private equity firm or buyout fund. And what we do is find really high quality, competitive, small and medium sized businesses, and we convert those companies from closely held, privately owned into 100% employee owned companies using employee stock ownership plans or ESOPs. So for us, really the core of our work came from, I used to work at an organization called the Democracy at Work Institute, was a national nonprofit that focuses on employee ownership as a racial equity tool, as a social equity tool. How can we use employee ownership to close wealth gaps, create higher quality jobs, and create better life outcomes for people? And so out of that work and out of the Democracy at Work Institute, we really came to the conclusion that the way to do that using employee ownership is you need to pull together the capital, and you need to find the owners who are looking to sell their businesses, and you need to give them an opportunity to convert those businesses to employee owned. So that's exactly what we've done and exactly what we're doing. And so to date, I'll say we have 2 companies in our portfolio that have diverse workforces. We have a landscaping company in El Paso, Texas called Accent Landscaping. We have a plumbing company, commercial plumbing company in Denver, Colorado called Apex Plumbing. And between those 2 companies, they represent over about 250 workers, 250 families who prior to the A&H transaction were employees in their companies, and they're still employees in their companies. However, they also now are owners in their companies, and their future and their wealth and their life outcomes are directly tied to the success of the companies. So one thing that I always like to say, employee ownership is great for workers, but it's also really great for companies. And a lot of really good statistics and data out there from the National Center for Employee Ownership, ESOP Association, and others shows that when you align the interest of the workers with the companies, you actually, for many reasons that are kind of obvious, you create better companies that last longer, that are more resilient, and that have better outcomes. So we're excited to have been able to do this for 250 workers thus far, and are looking to do it for a lot more throughout the life of our fund. So one more point, one thing that we always accent is we'll only invest in companies where at least a third of the workforce is diverse. And that's how we use the employee ownership tool to really address the racial wealth gap that way. And I've got some interesting stats I can tell you as well, but I'll let you keep asking questions and try to get to them.
Yeah. Todd, can you break down for us how the worker ownership transitions work?
Yeah, so in the Apis and Heritage model and our fund model, which is Legacy Fund 1, we essentially on the front end, we look very similar to any other buyout firm or private equity firm. And for us, it's really important for us to go out into the market as something that's familiar to familiar to owners, something that's familiar to brokers and investment banks. So we oftentimes move and talk and walk, and really we invest in companies the way that private equity fund would, in terms of what we're able to pay. So we'll, let me make it simple. We find a company, an owner that has been owning their business for 20 or 30 years. It's time for them to retire. And like many small business owners, they've created the opportunities for their kids to do everything they want. And that's exactly what their kids are doing. They don't want to take over the family business. And so they're looking at a variety of options, typically strategic buyers that want to buy their company, or traditional PE firms out there. And really what we do is we come in and we give those owners another option. And that option is for competitive pricing, similar pricing. You can sell your company to your workers, and our firm will be there for a period of time, approximately 5 years, to help make sure that that ownership is stewarded well, that we're training the workers, that we're filling any gaps in leadership, and that employee-owned company is going to operate as well, if not better, than the company under the previous owner. So we'll bring in the capital, we'll work closely with the company, sit on the board, and help guide them towards continued success and wealth building.
That's interesting, Todd. So the owners can sell out, as it were, just as if they were getting bought out by private equity. But don't some of them, haven't they had an intention to sell to their workers? But in the other, without a fund, they would essentially extend a note to their own workers and then have to delay their own payout, as it were, and you come in and let them exit. But do they come in, looking for the highest price, or do they come in wanting to transition to workers?
No, and that's a great point, David. And what you're speaking to is the fact that there's a decent amount of employee ownership, not as much as there could be out there using ESOP. So there are about between 6,000 and 7,000 ESOP companies out there in the market today. And as you're describing, what usually happens is, if I'm an owner and I want to sell to my workers in an ESOP, I'm going to have to extend most of the debt, most of the financing for the transaction. So if my company's worth 10 million, maybe a bank will lend the ESOP 3 million, but $7 million of that transaction I'm going to have to hold on to as a seller's note. And while there are a lot of sellers who want to do that and are able to do that, there's significantly more who are not able to do that. I think the 80%, the average entrepreneur or founder of a small business, 80 to 100% of their net worth is tied up in the business. So if they want to retire, if they want to actually exit and move on to the next stage of their life, maybe because of health reasons or family reasons, or they're just tired, extending a 70% seller's note or 80% seller's note and having to stay in the business isn't a real retirement. And so in our world, it's our belief that that's one of the reasons why you don't see more of those transactions. So we're really here to come into the transaction. And if they're looking at a traditional, strategic buyer who says, here's, 80, 90% of your liquidity up front, help us with the transition, and then you can go and retire, we need to be offering the exact same thing in order for them to really give this a serious consideration. And David, I'll tell you, man, when we come in and we're able to offer competitive price and terms and liquidity to these owners, the idea of selling their company to their workers becomes a lot more feasible. And actually, we always say everybody has a really big heart when you take care of their wallet and their pocketbook. So once we take care of their wallet and their pocketbook, I think we have a real competitive advantage in having owners go the employee ownership route as opposed to another route.
I want to leave a little bit for Ian to tell us about the advantages of ESOPs. Maybe what you can tell us is, how does the employee actually exercise this ownership? Like, does it come to them in shares of the company? Are they become shareholders, or what are the mechanisms where they actually gain ownership? The employees. Was that to me or no? Sorry, that's still on Todd, and you're going to get the ESOP question.
Oh yeah. Great. So, it can get really complicated. So to stay out of the weeds, I always say, think about an ESOP, an employee stock ownership plan, which is the model that we use for the company. We specifically use a S Corp ESOP. Think about it like a 401k. It actually functions very similar for a 401k, except instead of the assets in the 401k being stocks and bonds in the market broadly, or a lot of companies, it's invested purely in the equity of the company that the workers work for. And so it functions like a 401k retirement plan. If you retire after a certain age, 69 and a half, you can take it out penalty free. If it's before then, you have to pay a penalty on it. I think the important, or one of the most important things, is that in our model, the workers don't have to pay or give a paycheck contribution or come out of pocket in order for them to earn their shares in the company. What they have to do to earn their shares is to stay with the company and continue to grow the company and move it towards success. And what happens is that they vest into that ownership over time. So the longer you stay with the company and the more you help the company grow, you've earned your piece of the equity. And when you exit, when you retire, or when you quit, or when you get fired, you own that piece of the company. Those are your shares, and the company will pay you out those shares over a period of time. So employees don't have to come out of pocket. Once you vest in, they're yours, you own it. And when it's time for you to exit, you put those shares back to the company and you get paid out. It's it's a pretty good deal.
Great. Dennis,
I think that's good. Great, Todd. And thanks for getting into the weeds with us on this, because this is part of unpacking these structures is super helpful. But I want to bring in Zoe Schlag, who's working with a different structure, the Employee Ownership Trust at Common Trust. So Zoe, just tell us a bit about Common Trust and how did you land on the Employee Ownership Trust as a structure for this similar goal?
Yeah, so Common Trust is an employee ownership buyout platform, pretty similar to APIS and Heritage. We focus on supporting businesses to transition to employee ownership. We take a kind of different entry point into the conversation of employee ownership using a legal vehicle called an employee ownership trust. You may have heard that used interchangeably with purpose trust. I just want to clarify quickly between the two. An employee ownership trust is actually a type of a purpose trust that has been characterized to support employee ownership goals. So the two are actually the same legal vehicle. It's a purpose trust, which admittedly was a very esoteric corner of the legal universe 5 years ago. And then 2 years ago, Patagonia transitioned their business into a purpose trust structure. So as a result of that, we've seen a really large increase in interest in that particular legal model. The reasons that I got interested in employee ownership trust as a vehicle for employee ownership is a couple reasons. I think one of the most interesting things about employee ownership trusts is they are incredibly customizable. What that means for a selling business owner is when they think about exiting, they can exit to employee ownership, but they can also code in key purposes or values or culture that they want to see protected in their business. The reason that it's called a purpose trust is because it is a trust that has a set of purposes and it will be governed by those purposes. So, you may have one purpose around employee benefit and well-being, but for instance, we're working with businesses who say, we've been an organic wholesaler for the entire life cycle of our business, and we never want to see us give up organic farming. And so they can actually code that into the trust itself. We're working with another business right now that is a second chance employer. They've actually turned down a couple offers from private equity firms for fear of what would happen to their employment practices post-transition if bought by a private equity firm. And for them, they can use the purpose trust and the employee ownership trust to transition to employee ownership, but also say, this value we have of providing quality jobs to marginalized communities is something that we want to protect in the legal coding of our entity now and for the long term.
Can you share a bit about how the actual transactions take place and your role in that sort of stack or transaction?
Yeah, so we typically work with profitable small businesses that have been around for 10, 20, 30 years. You can do these for startups. It's just more challenging. We like doing these with businesses that have been around for a long time. Typically, the way that a transaction will work is, we work directly with the selling business owner to customize the design of the trust to map to the values and culture that they want to see protected in the trust. The transaction is then capitalized, typically through a combination of external debt and seller financing. Sometimes there's equity participation, but that's less common than the external debt and seller financing. That capitalizes the trust. The trust uses that to purchase the shares from the company, moving the shares of the company into the trust, and then investors and the seller are paid out through company cash flow over the term of the loan. So this works really well for profitable cash flowing businesses that are able to support that level of debt.
And then in this case, the employees aren't technically owners, but receive benefits of ownership.
Yeah, that's a really important distinction. So the trust itself owns the shares. It's not the individual employees who are owning the shares. However, because of the governance structure of the trust with a purpose around employee ownership and well-being, the employees will have guaranteed access to upside in the business and a role in the governance of the business. That looks different depending upon the business, the industry, any kind of dynamics that you need to factor into the design of governance. But the key characteristics of employee ownership that all employees have access to economic participation in the business, and the employees have some form of representation at the governance level are protected in the trust itself.
Similarly to Apis and Heritage, you've made your first few investments, and we covered one of them last year. Can you share a bit more about Schlag and the results to date?
Yeah, so Schlag Auto is a set of 4 family-owned businesses in auto. It's one of the first deals that we financed last year. They were really interesting because it was owned by 2 brothers, one of whom was ready to get out and go work on other businesses. The other brother wanted to stay in the business, and so he's continuing to lead these 4 businesses as CEO. We financed the transaction to transition the 4 businesses into a single employee ownership trust. And I mean, they've had some pretty incredible outcomes in their first year. So they transacted August of last year, so a little over a year ago. Within the first year of their transition, they had their highest customer service ratings in over 20 years of company history. They doubled their profits within the first year of transitioning, and they've had record profit sharing to all of the 50 employees who are at those 4 businesses. So it's very early, but pretty exciting outcomes for just a year transition.
Last question, Zoe. You were here in Austin when I arrived, so I've been tracking with you for a few years now. Unfortunately, no longer here. But talk us through your sort of arriving at ownership as an impact strategy, because I always thought that was a great story.
Yeah, I mean, admittedly, it came through an existential dilemma. The backstory here for me is back in 2016, 2017, I was in early stage venture in the impact space. So we were investing in these really high impact companies. And part of the question I kept asking myself is, particularly for those products that were addressing things like economic empowerment, social determinants of health, racial equity, I had this question in the back of my mind, which was like, okay, play this out to its logical conclusion of success. We scaled these products to impact people's lives. The company grows and exits. Given who sits on the cap table, net, when these companies exit, are we going to make wealth inequality better or worse? That question was just kind of like eating away at me, such that it got to the point where I just felt like, in order to address questions like racial equity and wealth inequality, I felt like we really had to explore the role that ownership plays in theory of change. So I ended up leaving venture to go explore the role that ownership can play as an impact thesis.
Terrific. Thank you, Zoe. So now we've heard a couple different models, and Ian, let's turn to you. I promised to give you the ESOP question. I think some people have generally heard that employee stock ownership plans, but just tell us, what's so appealing about ESOPs, and feel free to give us the background on Mosaic as well.
Yeah, sure. Thanks for having me. Well, I guess first off, I would say it's really it's cool to hear Todd sort of everything Todd said sort of echoes what we do at Mosaic. And we started off doing this 10 years ago, and in the early days we're banging our heads against the wall and blocking and tackling. So it's very honored to hear sort of Todd's success 10 years after we sort of started this mission. So that's cool to hear. Yeah, so I mean, the beauty of ESOPs is it's nothing new. ESOPs have been around since ERISA was put into laws in 1973, 1974. As Todd mentioned, there's 6,000 to 7,000 ESOP companies today. The challenge with ESOPs is, if you look back 20 years ago, there was 6,000 to 7,000 ESOP companies. And so you scratch your head and say, if this is such a great structure, or if there's such a demand for employee ownership, why hasn't that number increased? And I think the conclusion we came to, with myself and my partners having 20 years of experience around ESOPs, was the missing ingredient to scale employee ownership, and specifically scale ESOPs, was having capital next to the structure, right? So as Todd mentioned, 99% of ESOP transactions that get done today, except what Mosaic and A&H are doing, are seller-financed ESOPs. And to do a seller-financed ESOP, a business owner has to trade liquidity, and not a small amount, substantial, 70, 80% liquidity to do an ESOP. And so you have to be willing to take subjective and tangible benefits and have them override the financial decision. And so what we've been doing is very similar to Todd's model, which is, let's eliminate that decision. Let's put a attractive offer next to a business owner that can compete side by side with our lower middle market and middle market private equity peers. And then it makes the decision quite easy for a business owner, where we flip it around and say, if you can get the same value and the same liquidity, you know, Mr. or Mrs. Business Owner, why wouldn't you sell your business to your employees? And that's a tough question to answer. that you don't come back with an affirmative, I should sell it to my employees. And so I think what we're doing is taking a structure that's been in place for a very long time, has the appropriate guardrails to be successful, and putting the missing ingredient to it. And I think that has the opportunity to really scale employee ownership to be a much bigger piece of the overall private equity pie. And I think we all know the trillions of dollars that are out there on private equity. And so our goal is to create a model that's scalable, and hopefully, very proud to see A&H and others follow suit. And hopefully 5-10 years from now, it's 10, 20, 30 of us, not just one or two. But that's probably the highlights of the ESOP structure.
There's some benefits on the from the ESOPs on taxes for the company themselves, right? So once they get over this hurdle, there's actually some competitive advantages.
Yeah, I mean, we honestly look at it as, and I think we're very confident, and Todd made a similar comment, is, you know, it's one thing to have a strategy that's different and unique. It's another thing to have a strategy that's different and unique, and it's a competitive advantage and helps you win deals. And that's 100% what sort of this private equity ESOP strategy does. I mean, if you look back, the lower middle market is much more sophisticated today than it was 10 or 20 years ago. You know, 20 years ago, business owners barely knew what private equity was in the size of the market. You know, today, business owners are looking for different ways to do a change of control transaction. They want options. And as you've wrote in many of your pieces, and folks have coined this silver tsunami term, there's more owners looking to sell their business than ever before. And so really our model or the private equity ESOP model really combines the best attributes of private equity and the best attributes of employee ownership, right? We're bringing a strategic partner to the business to help create a 5-year roadmap. We're bringing resources to execute that roadmap. We're bringing capital to scale the business, to grow, do follow-on acquisitions. We're bringing the corporate governance, adding talent to a team, right? Adding folks to management team. And then, you know, the benefits on the ESOP, I think, are well known. Alignment of interest across the board, from shareholder to the shop floor. Meaningful benefit to retain and attract talent. And there's meaningful tax savings. The companies going forward, we pay no federal or state income tax. That's a huge benefit. That's more cash flows to go back in the business, deleverage the balance sheet, and grow equity value for the employees. And then there's a unique tax component for individual business owners that sell to an ESOP. That's Section 1042, which allows for an ESOP buyout offer to really look like a much higher offer because of the tax benefits to a seller. And so that allows us to compete with our private equity peers that perhaps may offer a higher cash value, but when you really factor in the tax deferral component on an after-tax basis, you know, our offers very often is more attractive.
I'm old enough to remember some headlines, and maybe others on the call are as well, about sort of abuses of ESOPs in the bad old days. I think some of the rules have changed to take care of that. So just what is different from the original rules?
Yeah, I mean, I think decades ago, folks used ESOPs for all sorts of reasons, none of which I think are applicable to what Mosaic or A&H or others are using it. To us, it's just a different way to do a change of control transaction. And by doing such, you're providing an opportunity to build, or really for every employee to share in the wealth building of a business. I mean, I've spent my entire career around sort of lower middle market buyouts as a banker, as a private equity investor, as an operator. And I think we've all seen an immense amount of wealth that is generated, and it tends to go to investors, management, and service providers. And everyday workers don't get a piece of the pie. And so an ESOP used in the appropriate structure, especially when you put capital next to it, gives everyday workers the opportunity to share in that wealth creation and share in a very meaningful way. I mean, we've been very fortunate with our first fund and the 15 ESOP investments. We've either created new ESOPs or supported existing ESOPs, and generating significant value that's more close to 1 to 2 times an average employee's compensation. This is an opportunity to have a life event that breaks generational cycles of poverty. These are events that can, put a kid or a grandkid into college. It could be someone being able to purchase a house. These are not just little extra benefits. These are sort of groundbreaking life events that makes a lot of sense. Where someone spends their entire majority of their time at work, why not give them the opportunity to participate in the equity value that every one of them are building?
You made mention that there's only a handful of you folks out there, and maybe there could be 10 or 20. Why not, hundreds or thousands of funds? And let me just, since we're in the weeds here, I know you're a small business investment company. Sure. under the SBA, which gives you some access, I believe, to kind of low cost capital. But I think you're the only one doing employee buyouts. I mean, why?
I would say today we are, for sure. So the SBIC program, for folks that are or not familiar, again, a very successful program. It's been around since the 50s. It's a self-funding program within the Small Business Administration. They put out or commit, I think, $4 to $5 billion a year. So it's a very big program. And the goal is to support small businesses within the economy. And, there's a lot of ways to sort of test what's a small business, but the idea is the government wants to make sure there's small businesses have access to capital. So we're preserving jobs and growing jobs in the smaller side of the economy. Majority of SBIC funds, I think there's about 300 fund managers. Majority of them are just pure mezzanine funds. So, they're the ones that are funding the mezzanine debt into your traditional private equity buyout structure. And then they're co-investing, 10 or 20% in the equity. That's probably 90 to 95% of SBIC funds. There are a handful that have more of a sponsor-like strategy, like us, where they're using sort of the benefits of the SBIC structure to go out and acquire businesses. And so, like anything, I think you have to create a track record and create a path for others to follow. And I think the SBIC program has just added a new accrual program and gone through a big revamp of some of their standard operating procedures, with the idea of trying to add more funds that have different models. And so, hey, we're hopeful that, who knows, maybe A&H's second fund's an SBIC fund, and maybe many others follow suit. I think it's a great path. And really, without getting in the weeds, the reason it's such an attractive strategy is the SBA does not participate in the profits of a fund. And so they're essentially your largest LP without taking a piece of the profits. And so what that leads to is a great opportunity to greatly enhance the returns to your private LPs. And so when you take sort of our strategy at an individual company level, and then you layer on the benefit of the SBIC fund structure, our net returns to LPs compete directly with middle market buyout funds. And we feel like if this is going to scale, you have to be able to provide not only impact, but you got to be able to provide returns, so you can bring in large investors that are interested in impact, but maybe not as interested as everyone on this Zoom. And that's really how we see this being a bigger piece of the private equity ecosystem.
Well, that's actually a terrific segue. Thank you, Ian. Segue to Annalisa, who has a bunch of private equity stakeholders in your orbit. So Annalisa, tell us about Ownership Works.
Sure. Thanks again for the opportunity to be here. It's been really fantastic listening to everybody. So Ownership Works is a nonprofit organization. We were founded in 2021 by Pete Stavros, who's co-head of global private equity at KKR. Our mission is like our peers on this organization. It's to increase adoption of broad-based employee ownership across the business community. We have set a goal of creating at least $20 billion of wealth for workers by 2030. And then, like most of us on this call, have a vision in the longer term of broad-based ownership being the norm at work. We have two main strategies for how we're marching towards this goal of $20 billion of wealth shared. The first we call movement building, which is generating a groundswell of interest in employee ownership across the private, public, and nonprofit sectors. And the second area of focus is hands-on guidance for investors and companies on how to implement broad-based ownership programs, which differ in structure from much of what's been shared today. So on this movement building side, the crux of that work is this broad partner consortium that we've formed. We have 79 partners right now spanning a number of key stakeholder groups. It includes financial services firms, professional services firms, pension funds, labor advocates, but private equity makes up a substantial bulk of that consortium. So there's 24 private equity firms that we partner with. They've made a commitment to implement broad-based ownership programs in at least 3 of their portfolio companies over a 2 to 3 year period. And we've made the commitment to support them with hands-on guidance, really drawing upon Pete's decade of experience doing this work within KKR's portfolio to come up with a replicable model that these firms can implement. On the hands-on guidance side of the house, so when these PE firms sign up, we give them, a sense of what to look for in their portfolio, what would be a good candidate for implementation, especially as they're just starting out. And so, we say you need an enthusiastic CEO that has like a people-first mindset and will really be excited about this. So you need sufficient amount of equity that you can share with employees to make the grants meaningful. At this stage, we've defined meaningful as providing employees with 6 to 12 months of their annual salary at the exit, assuming the investor hits their base case. And what this shakes out to be is a smaller percentage of the company that's owned by employees. And these are less formal structures around employee ownership. So it's not ESOPs, it's not an EOT, it's not a cooperative model. These are broad-based equity participation programs, either through broad grants of restricted stock units or pools of phantom equity that the entire workforce is participating in. When you take into account what's shared with the management team, it ends up being somewhere between 10 to 15% of the company that is owned by employees. And obviously, the management teams in these instances have the lion's share, with the broader employee base having a smaller share. We have obviously limited influence around that. And so we've anchored around the 6 to 12 months, encouraging people to be more generous where they can. I think the real potential here is that there's uncapped upside that the workers will participate in. So we've seen exit events already happening where workers are receiving well in excess of 6 or even 6 months or a year's worth of salary. So there's been a ton of momentum. There's been 24 private equity firms signed up. 79 companies have implemented programs to date, reaching over 100,000 employees. So I think we're starting to see some proof of concept around the ability of private equity to help us drive adoption at scale. I'll take a beat there.
Terrific. You answered my next question, which was how broad based is the ownership? Because I think there is the natural skepticism that the management team and the private equity firms are getting a lot, and the workers are getting some. It sounds like they're getting a significant amount. And as you said very transparently, it's not 100% like some of these other models, but just take it now from, you brought in folks that are not often thought of as as worker ownership champions. KKR is. We've had Pete Stavros on the podcast, but some of the other private equity firms, are they seeing this as corporate social responsibility, or are they seeing this as actually a competitive edge?
Definitely both. When we had the partnership conversations, we led with this is the right thing to do. And, talking about wealth concentration, the negative impacts that it has on our economies, on family economic security, how it's accelerating. So we grounded the work in the need around the social impact. But as, folks in the employee ownership space know, employee ownership can be great for the business too. And so we wanted to highlight the potential business case, share research and case studies showing the impact it can have on employee engagement and attrition and productivity and the financial performance of the company, and in turn the value of the company. So I think that people came in sort of equal parts, right? This is the right thing to do, and it's also good business. And we spend a lot of our time now, obviously helping people size and structure their plans, but really focused on building a culture of ownership, which is what leads to those outcomes for the company and better payouts for everyone overall.
It's interesting when we saw that KKR made the deal for Simon & Schuster a couple of weeks back, and one of the reasons that the Simon & Schuster management said for choosing KKR was the employee ownership stake. And it struck me that, okay, that's good for KKR. I wonder whether in the future you might have multiple private equity firms competing for how big a share they're going to give to employees.
That would be incredible. That would be wonderful. We are hearing anecdotally from our partners and from private equity firms that are interested in joining that businesses are proactively asking them, do you share ownership broadly? And that's wonderful, because I think we need influence and energy coming at this from all sides. And obviously it's compelling when they're bidding on businesses, if that's going to be a deciding factor. So that's what we're hearing more of now. Also in terms of acquisitions, so there's a public company, Ingersoll Rand, that was formerly a KKR portfolio company. They launched their broad-based program in 2016. They're a global company. They do acquire businesses. They have a fantastic culture. Since they've implemented broad-based ownership, they've had improvements in engagement, in safety, in attrition. And when they go to acquire a business, it definitely stands out amongst those business owners when they're considering their options, the thought that their employees will go to a business where they'll have a share of ownership, but also enjoy the benefits of the culture. So I think it's starting to trickle down, which is really great.
Terrific. Well, let's open it up. First thing I want to do is let each of you, interrogate each other if there's points that we've missed here, because you're all the experts on it. So, and then also I want to bring in some of the audience questions. I don't know, Dennis and Rudy, have you been? I've been haven't looked too much at the chat, but if you can pull up some questions.
Let's just kick it off with one from Ellen Frank Miller. A great question around. This was addressed to you, Annalisa, around what we know about employee participation in the business decision making, perhaps post ownership, or are there leaders out there amongst the private equity firms, or how are you thinking about that?
Yeah, so right now with the models that we have, there's no formal governance, but when we are advising companies on how to build a culture of ownership, there are several management practices that we recommend that are aimed at giving employees greater voice and a more opportunity to participate in the business. So that ranges from, a requirement of the program is that you do an employee engagement survey and that you include 10 questions that we've developed on an ownership culture. We recommend more transparency in the information that's being shared with employees. So having regular owners updates and owners meetings where you're sharing how the company is performing, including employees in continuous improvement programs, training managers to effectively delegate decision-making to employees, setting up mechanisms for two-way communication so that employees have an opportunity to share their ideas and managers are trained on how to receive those ideas. So it's more in the informal mechanisms of how can you shift the way a company is managed so that employees have greater voice. We have a labor advocates leadership council that we work with too, and we have a working session coming up with them in 2 months to delve into this a little bit more deeply as well. But it's in the informal lane, not formal governance at this stage.
Great. Actually, maybe let's take that more broadly. Is in the ESOP model or in the EOT model, is there actual meaningful governance participation by employees?
I'll kick us off. There can be, but there doesn't have to be. But as Annalise will tell you, Ian will tell you, everybody on the call will say, without the worker engagement and worker empowerment piece, the business upside or positive business effects of employee ownership aren't there. And there's research that shows that you can, say you have an ESOP in place, but you don't have an ownership culture, like what we like to call it, then you're not going to see any of that additional business growth or employee retention. So really investing into that piece is important. I can talk specifically about the A&H model. And I come out of the world of co-ops, started Democracy at Work Institute, which connected to the U.S. Federation of Worker Co-ops. So the principles and ideals and human-centeredness and worker-centeredness of co-ops really finds its way into the A&H model. And sometimes we use the term like ESOPerative to say that it's really, the ESOP as the tax and legal structure and the co-op as kind of the central structure. All that to say, so from a governance perspective, from the first year and a half of operation, we are putting a worker representative on the board of directors of the company, so that worker voice you do have to get that feedback loop between governance, management, and frontline workforce. And we haven't, we're not at an exit point yet, but in our model, during the 5 years of our investment, we're working with the workforce, training them on what governance means, doing a lot of the employee engagement, managerial interactions. And the idea is that when we exit our investment in 5 years, we'll be able to replace our seats on the board with worker seats, and the company will be majority worker governed. So governance is one of the primary mechanisms, but you have to prepare people to take over that role of governance, and we do that over time.
You have a nice acronym, ELBO, employee-led buyouts, right? That's part of it. Yeah.
Little play on LB, as you can see, little play on the LBO. So it's something cool.
Yeah, and maybe just one thing to add, and to that point, we might have said it, but just to be clear, in an ESOP structure, we don't, the investor doesn't control the board. So it's very different than in a traditional private equity model. We don't have ownership control because we're actually not a shareholder. We own warrants, and we don't control the board. And so it's an outside controlled board. And so your governance structure is very different than your traditional private equity model for that reason. And then I would echo a lot of things that Todd said. I think typically there's always an ESOP committee as well. And that ESOP committee does not include anyone from management. That's your everyday sort of worker population, and that the folks that participate on that rotate throughout the investment timeline.
I had one sort of technical question, or maybe it's not so technical, but Zoe, if I heard you right, there's a lot of seller financing required in these employee ownership trusts, which seem to be what Todd and Ian were indicating is often the obstacle to getting the deals done. It strikes me that maybe you could have a fund, A&H or Mosaic or something be the investor to take out the old owner, no?
Yeah, I would say we're seeing deals in both directions. So it's typically banks, regional banks or community banks who are participating in the senior position, but also recently the last 2 deals we've done have actually been 100% seller financed. That's pretty rare in the US. It's very common in the UK, but pretty rare in the US, and you're probably not going to see that with more traditional transactions. I think we're going to see more of that over the next year, 18 months, just primarily because we're in a high interest rate environment. And so sellers are able to provide their company functionally with more affordable capital that's more aligned with a transition that supports the goals of employee ownership. But we are not seeing seller financing as a barrier to employee ownership trust transactions in a way it might show up otherwise, which candidly has surprised me.
Yeah.
So you recently pointed out another interesting trend, which is a lot of folks think the company has to be a family-owned business, but in fact, you're seeing these transitions happened at venture-backed and PE-backed firms as well.
Yeah, I think this is going to be a really interesting space for this work, and one space that I'm like really excited for us to get into. It's more complicated, but one of the things we're seeing in our pipeline right now is businesses who are owned by a private equity firm who are very aware of the time horizon of this PE firm and know that they're likely going to look to sell in the next 12, 18, 24 months. And they've basically come to us and said, can we try to organize an employee ownership buyout of our PE firm's stake prior to them putting us on the market? There's a lot of complexity with that, much more so than when a business is 100% owned by the original founder owner. That's much simpler to deal with. But increasingly, I am seeing this as a channel of businesses that have basically, been owned by a PE firm that may not be thinking about the long-term health of the business. And when I say long-term, I'm talking about decades, like 50 years down the road, which is a lot of how these business owners are thinking about the legacy of their businesses. And I think EOTs can uniquely serve that aspect, caveated by we need to develop the capital landscape to support those types of buyouts.
Dennis, if I could jump in just real quick on that, I would echo. So we've created 13 sort of new platform ESOPs, since we started, and half of those were previously owned by a financial institution. So they're either private equity owned, family office, or an independent sponsor. And when we first had this concept, we would have guessed it would have been 90% founder owner. We would have never guessed that there was that much appetite. And so just echo sort of the comments there from Zoe. And I think the exciting part about that is what it should tell us is the market opportunity is even bigger than we thought, right? Is if it's not just founder owners that are available, and we can bring in sort of institutionally owned businesses that can then do a conversion to employee ownership, that just opens up sort of the opportunities even greater.
It sounds like a new strand of work for you, Annalisa. I just want to say before we go on, we're at the top of the hour. Obviously, if you have to jump to something else, go ahead. But let's keep this going for a few minutes if folks want to stick around. So, there is a question from our friends at Transform Finance here that since the upside for the workers happens upon an exit, which does not then guarantee continued ownership, it's more like sharing the upside. So because you're saying the workers are exiting essentially and they're no longer owners. Kurt or Andre, you want to extrapolate on that? Take yourself off mute if you want to do that.
I think they can
Kurt?
take themselves off mute.
I was just
You can now unmute yourself.
Yeah.
Yes, hi. Sorry. With respect to my question, it was really for the ownership works piece, trying to figure out if there is a moment where the workers are actually owners, right? Because I think that they get the benefit of their ESOP participation when there is an exit event for a private equity firm, but then subsequent to that, there's no commitment to them remaining worker owners. So what's been done in terms of creating a culture of ownership, etc.? Is that lost, or is there a way that it's preserved?
Yeah, it's such a good question. I was just typing up a response in the chat. Yeah, so usually PE firms will exit either and be an IPO, sale to another private equity firm, or acquisition by a strategic buyer. So we've seen in the instance of KKR, which has the most mature programs, instances of at IPO continuing the program. So that's Ingersoll Rand, where employees then get restricted stock generally. In the case of sale to another private equity firm, what KKR is trying to do, and then will now encourage the other members of Ownership Works to do, is to negotiate that the PE firm that's acquiring the business will continue the program. And we think that there's a good reason for them to do it, because if the employees have come to see the benefits of ownership, if there's this ownership culture, which you're probably factoring into the value of the company, it would be maybe not the best move to take it away from employees. So we saw that in the instance of KKR's recent sale of RB Media to HIG, and HIG made a commitment to restart the program. They're considering whether or not they're going to join Ownership Works. They're not a formal member, but either way, they've made that commitment, which is great. It's hardest in the instance of a strategic acquisition if that firm doesn't have broad-based ownership in place. The one example we have is CHI Overhead Doors was acquired by Nucor, a public company, which has a great culture and generous profit sharing. So there's some continuity there for the workers, but it is absolutely, a downside that it is this sort of potential window in time. I think we're really just focused on trying to make sure that an incredible amount of wealth is generated at these exits and making sure that employees get a chance to participate in that event.
Hi, I wanted to give Smitha, I know she's got to jump, but a final thought. And Smitha, I want to take it specifically. I was going to ask everybody, we started this with saying it's a path to bridging at least part of the racial wealth gap. And I just wonder if you have some thoughts on sort of whether that's a real potential, outcome of all this.
Absolutely. Well, I mean, I think the ultimate question is, can we take this to scale? And I think what you've seen through my many colleagues who are really on the ground doing this day to day is that there's a lot of different experiments happening in the market around different ways we can express employee ownership in regards to wealth building, but also the power sharing aspect. And so I think we're still in experimentation mode, demonstration mode across these often first-time funds. But as we take it to scale and demonstrate these new models, I hope that we'll have more of a track record and can bring in more commercial institutional capital. I think from my reflection, there is a big learning curve. So just appreciative of ImpactAlpha, the Transform team. I see Jenny from in the chat. There's a lot of really great people who are experts in employee ownership that we've leaned on to get up the learning curve. And I think we need to kind of help just make it more mainstream, because when you look at, I was really shocked by the number recently I received from a few colleagues that there's essentially a comparable number of union workers and employee owners in the country. And we talk way more, right, about unions and power of labor markets or labor movements than we do employee ownership. So how can we bring this on the same level of awareness? And that's one of our personal goals at West. So I'll stop there, but no, sorry, I have to leave early.
Great. Thank you so much, Smitha. Let's take it though more broadly. I know, Todd, you said you make sure that I think a third of the employees are diverse. Annalisa, you have some statistics on sort of the diversity of the owners in the various transactions. And I don't know, Todd, whether you track that or not. But just again, is this really a racial wealth building strategy?
David, it can be. It doesn't have to be. Just like this can be a quality job strategy if it's set up with that intention and those safeguards and protections in mind. It doesn't have to be. It could just be a retirement plan or a tax scheme for some folks. Speaking from the ESOP side, on the diversity side, racial equity. Again, ESOPs have been around for almost 50 years. And they've made a lot of working people in this country wealthy. Real, the stories of the forklift driver who retires as a millionaire because of the ESOP, or the the clerk at the grocery store who retires as a millionaire. I think what happens with anything when you're talking about racial equity or social equity, if you don't build it into the metrics, if you don't build it into the mission, it's not going to happen. And what we've seen is that workers of color who are in employee-owned companies, the ESOP companies, do better relative to their peers, but it's almost kind of a afterthought. Nobody has really targeted this model at those groups who need the opportunity the most. Your Black, Brown, Latinx, immigrant, rural folks in a real way. And that's what we're doing. I'll tell you one thing. So our baseline, we won't invest in a company unless at least a third of the workforce is BIPOC. To date, within our two companies, about north of 80% of the workers in our two portfolio companies are BIPOC. So if it's part of your mission, if it's part of who you are and what you want to do, then you're going to find a way to do it within the model and achieve the goal. So it has to be at the core and in the DNA.
Great.
Lori Felker-Jones, who's another former Austinite, has a good question around, is there any indication of preferences amongst workers for these various models? She flagged the idea of like the burden of ownership, something like the risk of ownership as well. How's that conversation being had, or is there any indication of worker preference for these structures? There's someone in the audience too that has an answer to that question. Be great.
I can jump in quickly. I wish I had a straight answer for this. The reality is it's relatively early, primarily because the EOT is so new in the US. So it's hard to really know. I think preference is really going to depend upon the business model, the business dynamics, industry dynamics, culture, the owner, the types of the cash flow profile of the business. Like all of those are factors that would influence a business to go one way or the other. So it's a really good question about worker preference. And I think it points to the complexity of like how you implement this, which speaks a little bit to Todd's point. I think implementing this well with employee input at the right stages is a really important success factor for actually building employee buy-in to the model that you're choosing to implement.
I wanted to bring up Amy Brakeman because she has a little bit of an answer to the question of how LPs can get into this and also scale up some new funds in addition to the ones we've seen here. So Amy, tell us about Unlock Ownership.
Hi, everybody. It's so exciting to be a part of this ecosystem. It's good to see so many of you. And a few of us who are actually asset owners decided that we were making investments in these emerging funds and some grants to other entities on our own. And then we decided, how about if we pool forces and see if we can invite in other catalytic capital that may not be in this ecosystem, may not be sitting in all these calls, may not be doing all the legwork. So we've launched, we are launching a fund of funds that is at this point catalytic capital, all DAF funds from individuals, to see how we can help launch the early funds in the space. Because we've talked to several of you who are launching funds and have now successfully launched your first funds. And, it's really hard to get the support early on that you can hire people, demonstrate that these models work, and then attract the bigger foundations or the bigger investors who are seeking market rate returns. No question, you guys are going to deliver good benefits for everybody. You're growing the pie of profits and growth and worker well-being and turnover, reducing turnover, all the good benefits we're all working toward. But we thought, rather than just investing ourselves, how could we try to be helpful in the ecosystem by using our efforts to crowd in other capital?
Terrific. Are there other thoughts out there, Dennis or Rudy? Have you been monitoring the chat, or should we, or any of you folks? I want to give each one of you a last chance as well, so we could turn to that if it's the moment.
Brian Fernandez, Halloran, you want to hop in?
Oh yeah, yeah. I was
Okay.
curious, Todd, you were mentioning how this approach might not be directly targeting gender and racial wealth gaps. But I was curious, since we're in these times of such great inequity that is so widespread, if employee ownership as a very direct way of actually dealing with those issues in terms of how they're localized around how a business is run, that it actually does deal with gender and racial wealth gaps, even if it's not being done in a targeted approach in that way.
Yeah, and no, and maybe the response is not to the degree that it could. And I'll say this. It's my belief that without targeting at those gender and racial wealth gaps and building in, the metrics and tracking that and doing all that, wealth impacts, you're right. It will have an impact, but we're thinking about almost a rate of impact. If you look at how wide and how fast the racial wealth gap and the gender wealth gap has grown, and the rate of that growth, it'll soon overshadow any kind of net positive benefits to these models. Again, if there isn't a concerted effort to make sure that you're impacting a certain number, or you're looking to impact a certain number of people of color or women or people with different life and social situations that make it difficult for them to access the economy and wealth. And I'll tell you this, Brian, even within employee-owned companies, you still find racial wealth gaps, right? They still exist inside of the company. They're a lot smaller than the racial wealth gap in the broader economy. But even, once it's employee owned, you're not done doing the work. There's a question of who gets what opportunities, who's at what role in the company, and who's able to build up those shares and acquire those shares more at a faster rate in the company. So, I think it's a good point. It's a good point.
And Brian, I can probably add a little bit to that, because when we raised our first fund, we did not have a sort of racial and gender inequity lens. We really came at it in the 13 to 15 timeframe as a market opportunity. We felt there was a need for capital to scale employee ownership, and that was really our primary focus. And even without that lens, our first fund created 2,500 employee owners, 37% BIPOC, and female BIPOC 60%. And so that's not surprising when you think about, we're focusing on the lower end of the economy, primarily service businesses. 50% plus of our portfolio are business services companies. And that is the demographics of that worker population. So now we've taken that and added more of an equities lens to our second fund. And our BIPOC numbers are not as strong as Todd's, but we're still 65% and female BIPOC at 90%. So the segment of where the lower middle market in these types of companies, if you really take a look at the census of who's working at these businesses, not only you're really going to address both. And, I think what the A&H guys have probably taken our model and taken it to one more level from a sort of proactive sort of racial and gender inequity lens. But it's a great opportunity. Even if you don't care about it, you will stumble into generating some significant wealth for disadvantaged populations just by focusing on this end of the market.
Yeah, I'd just love to add to that. To date, there's been 300 million distributed to workers through the programs that our partners are implementing. That's been KKR's portfolio, because they've been at this longer, and half of that has gone to workers of color. And that's because he had a focus on industrials. So those were a lot of the companies that were doing this early stage. And then the geography matters. And so right now we're trying to get people to be receptive to the model, to get some experience with it. But I do hope that, in the next coming year or so, we can see about what kind of targeted approach we can have in terms of industries and geographies, so that, to Todd's point, you have to bring that intention around the workers that you're impacting. And I hope we can kind of sharpen that lens at some point too.
And I think it's fair to add that this industry is really, really young. and our best practices are developing, week by week. And I think the more thought leaders that we bring into employee ownership, the better all of the funds that are deploying capital for this purpose will become. And so, where we are today, I think 5 years, 10 years from now, best practices will even be more evolved. And I think, if it's the top end of the market at Ownership Works, or where me and Todd are playing on the lower end of the market, it all adds to the outcome, which is trying to bring workers into the wealth creation of the companies that they're working at.
That's terrific. I would like to give you, if you do have some final thoughts, we can go around again. It seems to me that some of the questions in the chat go to sort of how do we create more demand for this, both by selling owners and maybe by LPs and others as well. So if you want to focus on that or anything else you have to add, and then we'll let everybody go back to their next call.
Happy to share my 2 cents from doing this for 8 to 10 years now. I think there is plenty of demand from the seller side. I think that with the proper education and putting options in front of sellers, the desire is there. I still think the challenge comes down to capital. And, in the fund management side, it's the top of the funnel, right? LPs drive fundraising for GPs. And if LPs mandate a worker ownership strategy, GPs will create that. And so, I think that at least from what we've seen, probably meeting with hundreds of business owners over the last 8 to 10 years, there is adequate demand from business owners. And the more capital we can bring, and there's all sorts of ways to do it, right? Whether it's Todd's strategy, our strategy, Zoe's strategy, what Anna's supporting, it's different ways to skin the cat. But it's all going to lead to workers being part of the being part of the equation, which is the right outcome.
For that, Ian. Actually, I have to jump. I just want to say thank you so much for the opportunity to be part of this conversation. And I'm just leaving feeling inspired by all of the commitment that everyone's bringing to this work. And happy to keep in touch and continue the conversation. Thanks, everyone.
Terrific. Thank you, Annalisa. Todd, you want to, any thoughts or Zoe, and then we'll let everybody go?
Yeah, I mean, just want to touch on what Ian said about the investors and the LPs and the power, the power that they have in the model. But but what's important to note, Mosaic will tell you this, Ownership Work will tell you this, is that, I mean, there's the business case for employee ownership models is there. It's there in a very real way. Zoe gave some really good stats and numbers on what they were able to do at their companies, where, what we've been able to achieve at these companies in a short amount of time we had them, from a business standpoint, from a financial standpoint, and what Mosaic's been able to do. I mean, there's a story there where I think if we as a sector or an industry, whatever you want to call the employee ownership world, do a good job at communicating the business case and the business value behind it, and LPs open up their minds and shift out of some of these old paradigms of ownership and what it means and what it doesn't mean. And I think all that's happening. I mean, I think it's, people say win-win and win-win-win all the time, but I think this is really a situation where investors can win, workers can win, companies can win, communities and states that are trying to keep jobs and companies there can win. I think this really is one of the best case scenarios, and it's an honor to be one of the people carrying the torch for the model. And so thank you for allowing me to be on the call.
Well, thank you. And Zoe, you get the last word.
Yeah, I think I'll just wrap up doubling down on the opportunity. I've shared this with several folks at various points, but it's 3 in 5 small businesses that are going to seek a sale over the next decade. And if you look at the current market of buyers, private equity, private buyers working with brokers, the deal volume they're doing is just going to absorb a small fraction of that market, something like 5%. So 95% of the small businesses who are going to seek a sale over the next decade, they're simply not a buyer. And employee ownership is basically an inbuilt buyer as an exit strategy. So it's one of the most scalable mechanisms to actually reach this market demand. And so I think, the big the big thing to be done is market education, both of sellers and capital providers, because the opportunity is here and it is going to hit us and it is going to pass. So I think, the time is really now to be investing in this space.
Terrific. Well, there's so much great stuff, and it's still cooking in the chat here. So we'll try to round some of that up in the post on Friday. We'll have a replay of the video of this if you want to pass it along to your friends who couldn't make it. I do want to remind you that we have a very active fall coming up. So next week we'll have this plugged in call with Sherelle Dorsey and the Black Farmer Fund, and then the following week we'll have the traditional State of the Impact Field call with Monique Aiken, Kathy Clark, and Fran Siegel. So we have your impact calls covered for the next few weeks, and check out all the details in the brief. Thank you so much all for joining us, especially the speakers, but all of you agents of impact as well. We'll see you next time.
Thanks, everyone.
Thanks all.
Bye-bye.